Good morning, ladies and gentlemen. Well, the speedometer does not lie. Minus 85, and when we went up last week, you will see that it went to what? From minus 39 to minus 4, down to minus 77, minus 79, minus 85. That means the spreads are absolutely collapsing internally. The last times when we had scores of around minus 95 was at the very, very low of 2011, and then again, well, we never got to minus 95. We got to minus 92 in was that 2015, and basically we stayed in that kind of range all the way from July until December of 2008. So you can see the environment that we're in. We're in either a 2008 or a 2011 or a 2015. That is basically the environment that we're in, and now we can go and have a look at in detail what we can expect for next week. The really interesting thing is that we got a counter trend buy signal on Friday at the close. You have to look out for these, and this tells me that the market is going to do something like this. It's quite a reliable signal. It failed us here, but I don't expect it to fail us here. That to me tells me that everybody yet again is going to be stopped out of their positions, and now everybody is going to be wanting to be short. We are going long of equities, not because we like equities, but because we like the positioning and the extremes that we're at. Before I go into the technicals in detail, you should read Kai's Twitter storm here, where he showed you the fundamental macro picture. Everything that he's posted here is A, extremely good, and B, completely true. Our model spotted this coming in October, and that's why it went long of TLT and short of SPY. We are just going to trade against the trend, which is always dangerous, but we recognize now, and I think everybody can now recognize from his tweets, that the fundamental picture has changed completely, and as always the spreads are the first to reflect it, and that is why our risk on risk off spread indicator gave the sell signal way back in December. Right, and so we start the review. 5-year notes. The belly of the curve, the most important part of the curve. My God, it's completely gone, hasn't it? Below the 200-day moving average, below everything, below even the daily Bollingers. Not a pretty picture, right? Well, what's going to happen here? Probably this. It'll probably actually stop everyone out by going and retesting the 200-day moving average from below. Either that or it completely collapses. I don't think the market can collapse until the Fed shows its hand on the 19th. We do have the Brexit vote in the UK, which is going to be gonna keep the market into risk off until it happens, and then we shall see. But also the 19th is going to be extremely important, and don't forget it's December, and people hate putting on positions in December unless they're absolutely made to do it. So I would have thought that the market is actually going to go sideways this week, work off the oversold indicators, and then, you know, once the Fed shows its hand, it's probably going to keep continuing to go down. It is not intelligent to fight the 5-year note. the 5-year note is telling you something very bad is preparing to happen in the US economy. 10s, same picture. And I would have thought it'll trade in the range of something like, probably take this out by a couple of ticks, so 280 back up to 293, 295. That I think is going to be a range for the week. I just can't see them pushing it down ahead of the Fed. And in the 30s, which are far far less susceptible to what the Fed does. We are right on top of the 200-day. We are right on top of the on top of the Bollinger Bands. So I would have thought that we bounce around for a little bit, and then eventually we break either towards the end of this year or beginning of next. TLT, as I said, once it basically broke back above 115.25, it was always going to be a one-way street. And we got straight to the 200-day moving average the same day. 118. You can see just as soon as it broke, gap above 200-day moving average, flat. Amazing how well these levels work. It's now, sideways for a few days, and then probably all the way up to 120, which tells you that the risk-off theme is going to last for quite a while. We ain't seen nothing yet in the long term. I just think in the short term, everybody wants to be short. Everybody is puking up. Everybody has got the wrong position, and I think they're going to get stopped out again. The most interesting chart for me is this spread between the 10-year note in Germany and in the US. We are back at those critical levels around the 259, 258 area, still staying slightly above it. This will actually drive the dollar. If after the 19th, and this is why I don't think anything much happens next week, because everybody is A, poised for something to happen next week, and B, because it makes fundamental sense that people should wait for the Fed, and C, we are at, we're below all the Bollinger Bands, we're very oversold. I would have thought that we wait until the Fed and then make a move. So the Fed action is going to be pivotal for the dollar, because if this spread starts now breaking down below, the 250 area, 248 area, the dollar is going to have an absolute nightmare. It's going to go, and I'll show you now, probably, 3, 4, 5 percentage points without any problem. So this is the chart to watch. This is the important one. And this is why I don't think it's anything much in terms of equity prices or bond prices is going to change this week. Okay, so this is DXY. We've just seen the spread between the US and Germany. If we now have a look at the recent range, what is likely to happen? Well, if we get that break that I've just mentioned, we will go straight to the 200-day moving average without any doubt in my mind. We're talking about below 93.63. 93.63 might hold it for a day or two, and then we go straight to the 200-day moving average, back to back to this 96 area. So you want to buy it at around the 93.63. Back up to 95, back down. So the dollar is the one that is in danger, because if now bonds start giving up and start heading a lot lower, which there is a very good possibility thereof, this is going to be reflected in the DXY without a doubt. Going on to equities, well, this is the monthly chart. It's frighteningly bad, which basically means it's quite good. We tried this this month, so we've been at the top where the resistance is, and we are now at the bottom without any real support. until, well, the first support I think is going to be the 2530s, you know, 2550s, that kind of thing. And then the real support is down, you know, 2370, 2400. That is the monthly picture. That is the picture that you should have in the back of your mind, because we are doing a counter trend trade, but we are realizing that it's counter the trend. By definition, it's a much more dangerous trade, so we will size it appropriately. We just don't think that December, ahead of the Fed, is the time that the market will completely puke, simply because 26.25 is still times 15 forward earnings, and unless we get some data which tells us that no, forward earnings are going to be a lot lower next year, it will definitely be a magnet for prices to return to all the time from the lows and from rallies. So we are not that afraid of a counter trend trade, simply because we think everyone is positioned the other way. So we would like to do a counter trend trade, and I have one in mind which I'll share with, which is very low risk, which I'll share with all the people at Charity Hedge Fund. But here we have the picture in the monthlies, and let's now go into the weeklies and the dailies. Right, weekly chart. We have to enlarge it to really see very much of anything. You can see how the market is still holding the Bollinger Bands. Every time it breaks the Bollinger Band, it goes straight back into the range. The Bollinger Band was 26.33, and you know, this week it'll probably be, I don't know, 26.25. So really a range. The market will probably break 26.25. It will probably break this 2600 level. It go all the way down here, but we think that by the end of the week we go back into the range. Simply because we just don't think that people are going to be wanting to have a position at extremes ahead of the Fed. And we have a trade to take advantage of that, hopefully, in the next few days. On the daily picture, it's even clearer. We have the Bollinger Bands probably on Monday around 2600. And then the market will probably do what it always does, and that is spike the Bollinger Bands, trade, you know, get everybody short, and then come right back up to where it was. I really would not be surprised if somebody said to me, Nick, guess where the market is going to close on Friday of next week. I will say somewhere between 2612 and 2675. That is going to be my guess at where the market closes. Now, what the range is going to be into week, probably all the way down to 2550. That is going to be my guess. So that is what I am seeing, and that's why I think a counter trend trade from these lower levels is very much appropriate. And we could, you know, because I always say that the market likes to be very close to all the moving averages when a big decision is about to happen. The big decision is going to be Wednesday of the week after next. And these moving averages are probably going to be down here, I don't know. So, you know, if somebody asks me where the market is going to be on the day of the Fed, I would say somewhere around 2675. That would be my guess, because I don't think people are going to be having it at 26.25, which is the times 15 moving average, Blue Angel, right on top of the Fed. I think it'll be a percent and a half higher than that when the Fed decision is about to be announced. Now, for absolutely weeks and weeks, I've been telling you that Europe is as dangerous as hell. Do not belong of Europe. You know, it's very ugly on all the spreads, especially against Japan. We've made big money there. So where do we take it off? Well, we take it off when everybody wants to sell Europe, and that's probably going to be on Monday because of the riots in France. What is the level? 29.53. Okay, 29.53 is our level. We don't think it goes through there. 29.53, we're happy to take back Europe. and sell our Japan position against it, we are more than happy to trade at that level. 29.53, we cover our shorts and think about what we're going to do next year, because there's no rush. Next year is next year. Enjoy Christmas, take your profits. Thank you very much, goodbye. And that is the spread against Japan. And here we are on Monday. We will probably be here somewhere. So probably another percent, or just less than a percent. As you can see, these are extreme levels. Fundamentally, I like the position, don't get me wrong, it'll keep on going at some stage, but the odds of a nice bounce back up are very, very great, and that's why I think Monday is probably going to be a great time to take back shorts in Europe. Another spread that is interesting is this is gold against SPY. So this is basically a risk-off indicator. As you can see, really around the 21 area, it's going to have a lot of support, and we are at 22. So, you know, exactly what I'm saying earlier. You get a bit of a nightmare in stocks. People sell it 1.5, 2 percentage points through where we are at the moment. Oops, goes straight back up. This would tally with what I'm saying. Equities are probably going to be higher than they closed on Friday, on Wednesday the 19th, before the Fed decision comes in. That's what I think. Little counter trend trade, costs very little by the way that we're going to structure it. If it works, great. If it doesn't, who cares? This is a weekly Nikkei, and I'm showing it to you because you have to keep on watching the Nikkei. The Nikkei is the source of liquidity. It's telling you what is going on with the only market that is still being supported by the central banks. Excuse me, where there is QE as opposed to QT. If that starts having a nightmare, then all the other markets are going to basically die of death. This is the least bearish market there is out there. You can see all these moving averages converging here around the what is that, 22,400 level. So that is going to be the key level. I'm not expecting that level to be surpassed. But what I'm saying is that whenever you see the 22,400 level, that's the place where you want to start buying options in this market and all the other markets, simply because the volatility here is going to be probably less than the volatility you're going to get in the other markets. If by any chance, and I can't see this, we actually manage to go above 22,400, we are going to have the most amazing squeeze in everything else. So that is why I watch it very, very carefully. And that is also why I don't think that we break down very seriously in S&Ps or even in Europe next week, simply because you know, another 100, 200, 300 down, we're going to have a lot of support, and we're not going to be able to break this very, very seriously. Those of you who have been following my tweets, you will know that I think that XLF here is key, absolute key, and this is, you know, the short-term chart of it. We have this gap down to 24.12. At some stage, this 24.12, 24.15 area is very, very important, and that's where I have my bids to take back the shorts. Can we see a breakdown there? Yes, we can, but with the picture as it is, we might do one of these. See? Basically collapse through the Bollinger Bands and everything, trade down, fill that gap, and then come straight back up to where we closed. To me, that is the most likely scenario. 26.25 is still going to be extremely important. I just can't see us pissing straight through 26.25 and never coming back to it. That to me is highly unlikely, not with the fundamental situation as it is, and not with the Fed on deck on the 19th. So more than happy to take back my shorts in XLF. If I'm happy to take my shorts back in XLF, I have to be happy to be long of XL, of SPY. The other very important one, XLK, you will see that we will have a lot of support here. We will have a lot of support, 63, 62 something. I just can't see this market going straight through these supports. I think we will bounce around here for quite a while. And that is why I just can't be short for any length of time, naked short below 26.25 in the S&Ps, because I'm absolutely convinced that the market trades back to that level without a doubt. So the biases for next week. As we said, 115.25 TLT, there will be volatility in bonds, and there was. It's gone. Get long against the retest of the 200 MA from below. As I showed you, think the 5s and 10s go back to the 200 MA at some stage. That's where you want to get long of the bonds, simply because it's just too easy, isn't it? I mean, you could stay long of it, but I prefer the counter trend risk on trade for next week. Nothing has changed in XPX. I would be very uncomfortable excuse me, being naked short for any period of time sub 26.25. Can you trade your sub 26.25? Of course you can, but I would not position sub 26.25. I see that as completely pointless for the next few days. Now VX, absolutely spot on, 16.30 to 24, closes above 21 indicate immediate danger. We got the close above 21. That means that we will try to force through the 26.25. I don't think we succeed, but we don't have much hope of seeing much lower VIX prices until after the Fed and the Brexit vote. People are just too scared. They will be buying options for protection, so don't expect the market to collapse there. Without a doubt, I see no point in being short of volatility unless we get to stupid levels above 24. Okay, I showed you European equities, 29.50. Stocks, that's where we cover our shorts. We say thank you very much indeed against all the other spreads. DX, we are 96.50 now, but we think that there is an increasing odd of seeing 93.63, where you really want to get long of straddles, because from that level it will either go straight back above 96.50 or it will just collapse. We've been saying this for a while. It still applies. It's still risk off, and risk off can last for months. It can last for years. So if you have a portfolio with equities that you want to hedge, by all means hedge them with indices, but make sure that your individual shares are the low beta, high quality end of the spectrum, and then you hedge them against with something which is high beta. So this, although we think next week this might stop and trade around a bit or retrace, the trend is very much in place. These contracts are at some stage going to have a problem, these very much less. Thank you very much indeed, and tweet you on Monday.